In 1996, the market hit an all-time record of 8,090 companies publicly listed on the various stock markets around America. Today, almost 30 years later, despite the economy being 3 times larger and the market handling about 7 times as much capital, there are fewer than half as many companies publicly available to buy shares in. There are a lot of theories about what is going on here, from private equity making Wall Street irrelevant, corporate consolidation, to the dwindling of savings of average investors. But there are some even bigger issues at play here. So where the fuck did all the companies go? At the time this video was released, 34.1% of market capitalization of the S&P 500 was comprised of just 7 companies: Microsoft, Nvidia, Apple, Amazon, Meta, Alphabet, and Tesla. If you throw in Berkshire, Broadcom, and Walmart, then that is over half of the entire market in 10 companies. According to data from Standard & Poor's, at the end of 2015, the top 10 companies only accounted for 16.2% of the market. So, in less than a decade, the market concentration within the biggest companies has tripled. Even if there were more companies that the public could invest in, they would matter a whole lot less. This trend is bad for investors, bad for workers, bad for consumers, and strangely, it's actually even bad for the companies themselves. But I am getting ahead of myself. First, we need to know why this is happening.
The Great American Startup Boom. In 2023, a staggering 5.5 million new businesses registered in the U.S. Experts predict 2024 might break that record. This boom suggests a landscape teeming with fresh ideas and a dynamic economy. But while Main Street buzzes with new ventures, Wall Street tells a different story. It's a tale of shrinking numbers and a landscape becoming less public. More new businesses are born than ever, yet the traditional path to public trading is fading. It's like a town where thousands of babies are born, but the number of adults keeps shrinking. Where are these companies going? Why aren't they maturing into publicly traded titans? This mystery affects more than just stock tickers. Let's unravel it. The incredible shrinking stock market, a public disappearing act. In 1996, there were 8,090 publicly listed companies in the U.S. Today, fewer than 4,000 remain. The U.S. economy is 3 times larger, and the stock market handles 7 times more capital. Yet, the number of public companies has halved. Economists expected around 25,000 public companies today. Instead, we're struggling to hit 4,000. This isn't a minor blip, it's a fundamental transformation. Thousands of companies are opting out of going public. This shift affects how businesses are financed and who benefits from their success. The decline in publicly traded firms has real-world implications for investors, competition, and innovation. We need to understand why this traditional pathway is becoming endangered. Private equity, the not-so-public darling of the corporate world. Private equity PE is booming, with funding skyrocketing by 1,200% since 2000. Thousands of companies that might have gone public are now opting for PE. Instead of IPOs, they're selling to private equity giants. Private equity firms are increasingly selling successful companies to other PE firms. This keeps more value locked away from public investors. The public markets are becoming an afterthought. Let's explore why. The IPO gauntlet. Why companies are saying no thanks to going public. Going public today is like navigating a complex, expensive obstacle course. Compliance and regulatory requirements are massive deterrents. Acts like Sarbanes-Oxley and Dodd-Frank have increased the cost and complexity of being public. Quarterly reporting and shareholder pressures add to the burden. Many executives prefer focusing on building their business privately. Unless a company is exceptionally large, staying private often seems more appealing. Private equity offers a large check and patient capital. The public markets miss out on dynamic mid-sized companies. Big Tech's block party. How a few giants ate the S&P 500. The top 7 companies in the S&P 500 account for 34.1% of the entire index's market cap. The S&P 500 is supposed to represent 500 of the largest American companies. Yet, a tiny handful wields immense financial weight. This level of concentration has tripled in less than a decade. The performance of the entire stock market is increasingly tied to a few mega corporations. This raises questions about market diversity and systemic risk. If one or two giants stumble, they can drag the whole market down. Investing in the market means investing disproportionately in these tech behemoths. The lack of breadth in market leadership is a concern. Let's delve into the implications. Meet the landlords. The trio quietly owning almost everything. BlackRock, State Street, and Vanguard are top shareholders in almost every major U.S. company. They manage assets worth tens of trillions of dollars. Their presence is ubiquitous. They primarily manage assets on behalf of millions of individual investors. The rise of passive investing has funneled trillions into these firms. They own significant stakes in virtually every company within major indexes. This concentration of ownership gives them immense potential influence. They have voting rights in thousands of companies. Let's explore the impact of their dominance. Friendly rivals? When your biggest owners want everyone to win, just a little. Common ownership occurs when large institutional investors hold stakes in multiple competing companies. This can dampen competitive fires. For example, Vanguard holds stakes in major airlines like Delta, Southwest, United, and American. When shareholders have a vested interest in the entire sector, competition can be reduced. This phenomenon isn't limited to airlines, it's observable across various industries. Common ownership can lead to less aggressive competition on price, innovation, or service. Companies might focus on strategies that benefit the entire industry. This can lead to higher prices and lower quality for consumers. Let's examine the consequences. The hangover: who foots the bill for this corporate concentration? The transformed corporate landscape affects everyone. Investors have fewer opportunities to invest in high-growth firms. Workers face cost-cutting, layoffs, and wage stagnation. Consumers experience higher prices and lower quality goods and services. Less competition leads to a less vibrant economy. Even large companies might suffer from a lack of dynamic competition. The concentration of power has far-reaching consequences. Let's explore who pays the price. Back to the future, market monopolies and why history has its eye on us. The current state of affairs echoes past eras like the Gilded Age. Powerful trusts and robber barons controlled vast swaths of the economy. This led to significant social and political unrest and antitrust reforms. Today's market concentration is driven by different mechanisms. However, the outcomes: reduced competition, concentrated power, and growing inequality are similar. The long-term risks of this concentration are substantial. A less competitive economy can lead to slower growth and fewer opportunities. Concentrated economic power often translates into concentrated political influence. Let's consider whether this is the new normal or a dangerous deviation.